All right, welcome everyone to this detailed explanator on Chapter 2 of the NISM Series 12 curriculum. Today, we're going to break down the core building blocks of the securities market, what they are, the key differences between them, and how they actually work. The goal here is to give you a really solid grasp of all the essentials you're going to need for your exam. So, let's take a quick look at our roadmap for this session. We're going to kick things off with that core distinction between equity and debt. Then we'll dive deeper into each one of those. After that, we'll explore some other key asset classes you need to know about, talk about asset allocation and valuation, and to wrap it all up, we'll do a review of some common exam questions just to make sure everything sticks. Okay, let's dive right in. You know, at the very heart of finance, there are really two main ways a company can raise money. And these, in turn, create the two main ways for you to invest. Understanding this difference between equity and debt is without a doubt absolutely foundational.
And this slide, it really lays out that fundamental trade-off perfectly. See, if you invest in equity, you're an owner. Your potential return is totally variable. It could be huge if the company does well, but so is your risk. And you have what's called a residual claim, which is a fancy way of saying if the company goes bust, you get paid last. Now, on the flip side, as a debt holder, you're a lender. You get fixed interest payments, which makes it much lower risk. And you have a priority claim, which means if things go south, you are first in line to get paid.
Okay, to really make this stick, think of it like this. Imagine you become a partner in a new restaurant. That's equity. If it becomes the hottest spot in town, you could make a fortune. But if it fails, poof, your investment is gone. Debt, on the other hand, is like being the bank that gave that restaurant a loan. You don't really care if they sell one burger or a million. You just get your agreed-upon interest payments as long as they stay in business.
All right, so let's build on that idea. We're going to focus just on equity now. We've already established that it's all about ownership, but what does that truly mean for you as an investor?
So, the most important point is right there at the top, ownership. And that's exactly why people call it risk capital. You're literally taking a risk on the future success of the business. Your potential reward comes from two places: dividends, which are never guaranteed, and the hope that your share price will go up. And importantly, this ownership gives you voting rights on major company decisions. And you have to remember that term, residual claim. It means you're at the back of the line if the company ever gets liquidated.
Now, it's important to know that not all equity is created equal. Ordinary shares, that's your standard bread and butter stock with full voting rights. Then you have these things called DVRs, or differential voting rights shares. This is basically a trade-off. The company might offer you a higher dividend, but in exchange, you get less voting power. It's a way for founders to raise cash without giving up control. And finally, you've got preference shares, which are kind of a hybrid. They pay a fixed dividend and get paid out before ordinary shareholders, but they usually don't have any voting rights.
All right, great. So we've covered ownership. Now let's flip over to the world of lending. And to really get a handle on debt securities, you just need to understand three core components. Think of them as the key terms of the loan agreement. First up, we have the principal. You'll also hear it called the face value or par value. It's super simple. This is the loan amount. So if a bond has a face value of 1,000 rupees, that's the amount the company borrowed and promises to pay back when the loan is due. Next, the coupon. This is just a fancy word for the interest rate. It's what you, the lender, get paid for letting them use your money. So if our 1,000 rupee bond has an 8% coupon, that means the investor gets 80 rupees in interest every year. That's the fixed income part of a fixed income security.
And finally, there's maturity. This one's easy. It's just the end date of the contract. It's the day when the issuer pays back that principal, the 1,000 rupees, to the investor, and the loan is officially over. This could be short, like 90 days, or really long, like 30 years.
Okay, now listen up, because this is a huge concept for your exam. There is an inverse relationship between bond prices and interest rates. Think about it this way. Imagine you own a bond that pays you an 8% coupon. Now, what happens if the market changes and brand new bonds start paying 10%? Well, your 8% bond suddenly looks a lot less attractive, right? So to sell it, you'd have to drop the price to make its overall return competitive. The opposite is also true. If new bonds only pay 6%, your 8% bond is now a hot commodity, and its price will go up.
Okay, so while equity and debt are definitely the two big pillars of the market, they're not the only game in town. Investors have access to other kinds of instruments, and some of them actually blend the features of both. Let's look at convertible debentures. These are pretty cool. They start their life as a normal debt instrument, paying you a fixed coupon. But, and here's the interesting part, they come with a special option that lets you convert that debt into a set number of the company's equity shares down the road.
This gives you the safety of a bond at the beginning, but the potential for big gains like a stock if the company does really well.
Next up, derivatives. Now, these are a bit more complex. The key thing to remember is that their value isn't in the instrument itself. It's derived from something else, like a stock, a commodity like gold, or even an interest rate. The most common types you'll hear about are futures and options, which are basically just contracts to buy or sell something at a set price on a future date.
To make this a little simpler, a really key use for derivatives is something called hedging, which is just a way to manage risk. You can basically think of it like buying an insurance policy for your investments. For example, a farmer could use a derivative to lock in a price for his wheat crop today. That way, he's insured against the risk that prices might crash before he can sell it. It's a tool for transferring risk.
So you've got all these different tools, equity, debt, these hybrid things, derivatives. How on earth do investors put them all together? Well, this brings us to two really crucial concepts: asset allocation, which is about building your portfolio, and valuation, which is about figuring out what each piece is actually worth.
Asset allocation is really your high-level game plan. It's less about sweating the details of which single stock to buy and more about deciding on the big picture, what percentage of your money goes into different buckets. So a younger investor might put 80% into higher-risk stocks for growth, while someone closer to retirement might have 70% in lower-risk debt for income. It's all about your goals, your time horizon, and how much risk you're comfortable with.
Okay, so once you've decided on your allocation, say 70% in stocks, you still have to figure out which stocks are worth buying. And that's where valuation comes in. It's the process of determining a security's real worth. These three ratios you see here, the PE ratio, the price-to-book ratio, and dividend yield, are some of the most fundamental tools analysts use. So let's start with the big one, the PE ratio, or price-to-earnings ratio. This formula basically asks a really simple question. For every single rupee a company earns, how much are investors willing to pay for a piece of that company? A really high PE ratio often means that the market expects that company to grow very, very quickly in the future. All right, let's bring it all home. To make sure you've got the most critical points from this chapter absolutely locked down, let's do a quick recap of three concepts framed as direct questions that you're very likely to see on the exam. First up, what is the relationship between market interest rates and bond prices? The answer is simple. They are inversely related. When market interest rates go up, the price of existing bonds that pay a lower rate has to go down to stay competitive. And when rates fall, those older, higher-paying bonds become more valuable, and their price goes up.
Second, you need to know the pecking order in a liquidation. Debt holders are lenders, so they have a priority claim. They are at the front of the line to get paid from whatever assets are left. Equity holders are the owners, and they have a residual claim. That means they get whatever is left over, which, frankly, is often nothing at all. And finally, a really crucial one. Who do a company's reserves belong to? You have to remember, reserves are just the profits the company has kept instead of paying out as dividends. And since the equity shareholders are the true owners of the company, those reserves rightfully belong to them. It's part of their ownership stake. If you can nail these three concepts, you will be in fantastic shape for this section of your exam.